Good afternoon. This is Tom Alexander. It is Saturday, March 9th. This is the video addendum to the written report for the week that begins on Monday, March 11th. If you are new to the channel, please like and subscribe. I hope you find value. It will be very helpful if you will like, subscribe. If you make comments, that's helpful too. I am happy to answer any questions you may have. Okay, let's get into the market. So the remarkable bull run that began at the end of October at the October lows and all the indices continues. And all bull legs, if you go back and look throughout modern history, at least since I've been trading almost 40 years. And if you go back and you look at strong bull trends, this one really isn't all that unique. Now, all bull trends tend to have certain personalities within those bull trends, meaning some bull trends will go up, 20, 30% before there's any sort of meaningful correction, but they will have interludes of balance and time spent between higher highs in that bull leg, and some of them will have deeper retracements against the previous high. Some of them are relentless to the upside. This happens to fall in that category. The current rally, particularly in the SPX and the NDX, are pretty relentless, and people seem to have very, very short memories where they haven't been in the market very, very long, because they act like this is unprecedented, and it really isn't. But if you are a trader, what you're trying to do is to figure out what is happening and then adjust to what is happening and trade it accordingly. So let's take a look at the charts. Okay, I'm going to go through each of the indices, but I'm going to spend some time with the SPX here, and I'm going to sort of give a little bit of a trade lesson in how to analyze a market and what's going on. Now, a lot of people find me through Market Profile. I have been using Market Profile almost since it was initially posited by Peter Settlemyer back in the mid-1980s. But I'm not a Market Profile trader, and you should not be a Market Profile trader either. It's not to be traded. It was never, well, I can't say it wasn't. It was initially intended to be traded, but that was proven to be wrong. But like everything else in traderland, it has been hijacked by magicians and turned into this magical thing of causative as opposed to correlation, and a complete misread of the information that Market Profile provides. Market Profile, the highest use of Market Profile is to identify market condition. As you can see on my screen, this is a bar chart. We're going to talk about the bar chart, but if from a market profile perspective, which is really a sort of a misnomer for auction market principles, and it's really auction market principles that you want to study, not market profile. Market profile is a vestige of the auction market process. But what this is in market profile terms is an initiative move. It is a move that is directional, and it's pretty relentless, and the retracements have been fairly narrow. Now, all of that's sort of more academic. Again, I'm a trader, so I don't care what you call it. Let's just try and make $1 out of it. I mean, that's sort of my attitude. So I frame my analysis with the intent of trying to make money from it. Otherwise, to me, it's useless. It's just, I'd rather solve a word puzzle or something like that. But let's take a look at what we have here, and let's look at the objective information that we can find from this chart. First and foremost, let's just look off this low. The SPX into Friday's high has been up 26.5%. That's a lot. Now, what is even more remarkable about the rally, and I've been talking about this for weeks and weeks and weeks, are the extremely minor and short-lived retracements. The biggest retracement, and I'm going from print high to print low, not even from close to close, which would be even less. There's 2.27%, 1.73, 2.52. Now this is the largest decline that we've seen, and it was over in 10 hours. And now from Friday's high to Friday's low, this is a fairly significant one-day drop. It's about 1.35%. So what is the takeaway from what we're seeing here? Well, there are a couple of things. We can sort of divide this rally up so far into two segments. This would be segment one. This is segment two. Now, segment one carried, I'm going to do this a different way. I'm going to show you. This is a pretty cool tool. All right. So this carried, I'm going to expand this so we can actually see the thing. So this segment of the rally carried over 16.5%. It's up 682 points plus at a slope of 16.25. Slope is sort of a rate of change calculation. Now, if we count this as leg two or segment two, okay, we're up. This is a slope of 11.55. Slope is considerably less. The gain is considerably less. Now let's see the time difference here. So this lasted. Let me find it here. How many trade days was this? This was 42 trade days, and from this low, we're into roughly the same. This is about 43 trade days. So this is a really good apples to apples comparison in terms of time. And it's clear now, this is objective. This is not made up. This is not supposition. This is what it is. Now it can change, but it is what it is. So segment one of this rally lasted 42 trade days, was up 16.6% at a slope of 16.25. Segment two so far I'm talking about from print high, okay, it's lasted 43 trade days at a slower, a lesser slope, i.e. rate of change, and the gain is not as much, okay? So the rate of change of this move off of the low here, the overall has slowed down. And if you're following my weekly reports, I started saying way back here that the rate of change that the market was going up would not continue. And that's a basic auction market principle. It's an auction market concept. So this is not a big surprise. Now I'm going to get rid of some of this stuff, and we'll take a look at a couple of other, I think, salient points about this market. So this is and you can see here what we've also done in segment, let's call it segment two. We've developed a very, very well-defined channel. And the SPX has stayed inside of that channel since the low on very early January, the dip off the December high into the early January low. That first week in January, we got ripping higher. So let's just analyze this leg. So what has this leg been doing? Well, it's predominantly up, but it has become more two-sided. We'll have an up and a down, an up and a down, an up and a down, up and a down in a rhythm. Now, and I'm not going to get too deep into this. If we do trade to a higher high next week, be paying attention. I'll send out another report on projections using the information from this leg up as to where this market may stop if we do take out this high. Now, the other thing, or another thing that is important just from looking at this chart, where's resistance? Where's support? Well, if you're an auction market trader, you don't use magic as your potential resistance, potential support. And actually, the terms resistance and support are better named key reference areas. They are inflection points from where the market is likely to move sharply. So obviously, Friday's high is important. So what's important to the downside? Well, if you look at the chart, the market itself has defined this area right here as important. Why? This was a print low, this was a print low, this was a print low, this was a print low. All of these lows are clustered at or just above 50.56. So this is clearly, the market itself has defined this as an important level. This level has been rejected 1, 2, 3, 4 times and unable to break. If we close below this level, and I've highlighted these in the written report. It's also, you can go to the website, alexandertrading.com, and you can see all the charts that I'm going to show you, and you can see the levels that I'm going to show you today too. So you don't have to, you can refer to those during the week if you choose. If we get below this level, then we'll reassess and determine based on how we got below this level, if the other indices all close below this level. All of those things come into play when you are analyzing a market and making a quote unquote forecast. It's not as rote as saying, okay, if we close below this level, the grand Armageddon wave 55555 super cycle top for the next 3,000 years is in place. It's not that simple. It doesn't work that way. You have to assess each day after that day has occurred into the context of how it occurred. And when you're talking about the U.S. stock indices, you have different indexes to take a look at to see if they're confirming or not. And that is a huge component of what so many traders miss. It's fine if you just want to trade the ES, if you just want to trade the NQ, if you just want to trade the Russell futures or the Dow futures or whatever, but you better be looking at all 4 of them in the bigger picture to understand the context of the particular contract you're trading. So now we know, we can objectively identify, because these are levels that have been created by actual market participants themselves. It's not some magic pulled out of the blue that suggests the market has to stop there because it's a Fibonacci extension, retracement, a Gann angle, a certain astrological event, etc. Now, all of those things may coincide with this, and that's fine. But I do know that nothing significant happens to the downside unless this level is taken out. I don't care how else you want to attribute it. That's what has to actually happen before we can talk about something significant developing to the downside. So our downside level as we head into Monday in the SPX is 50.56. The upside level is 51.89. Okay, let's move over to the NDX, and we'll go through a similar exercise, but shorter, but the exact same concepts apply. Okay, so here's the NDX, and the important level here, and then here. That's, as a trader, that's objective information, and it's about the only objective thing I can identify in this time frame. Now, if I wanted to, I could go down in time frame to a 60-minute chart or a 30-minute chart and see where the most recent pivot, lower pivot high was, and that would be my lean. Okay, let's look at the Russell. Now let's look at the Dow first. And then we'll look at the Russell. The Russell is a little bit different. So here's the Dow. Now, the Dow is interesting because it actually has 2 levels now to the upside. It will be Friday's high and then the high of the 23rd. Now, something I want to point out about the Dow, if you notice, the NDX and the SPX have been trading in new all-time highs, making higher highs and new all-time highs almost on a daily basis. The Dow has been lagging. That's a divergence. This is the type of divergence that will occur if you go back and look at every single major high and low of significance. Now, the problem with that is that doesn't mean this is, again, the signal of some cataclysmic top, but it's a heads up. And there are a lot of false signals. All it takes for this to be erased is for things to turn around on Monday. We'll go ripping higher, and the Dow leads the charge to new highs. But we can know now Friday's high is the immediate upside key reference area, and then the low of the 5th. All right, let's move over to the Russell. And the Russell is sort of its own animal, as we all know. This was a potentially important break above this level in here, and it remained. I'm still watching the Russell very closely, but these are the levels that I'm keeping an eye on in the Russell. Okay, now let's take a look at the profile perspective. And again, this is a particular. It's basically a way of displaying data. Now, the chart you see on my screen is basically a bar chart. If I collapse this, I'm going to remove all the splits. Then what you see here, well, something is awry. There we go. What you see here on my screen are quarterly profiles. Each letter is 1 week of trade. So the way this is defined time-wise, chronologically, is each profile unit, and the current quarter is not complete yet, is a quarter. Okay, it's a quarterly auction. But the reality is the auction process is ongoing. It's constant in all degrees of time all the time. So this is somewhat of an artificial constraint on the auction process. So if we split this out, we can see what's actually a more accurate view. And we have a market, again, from an auction market perspective, this is an initiative move higher. We've had one little pocket. Let me grab a tool here. We've had one little pocket of balance right here. So this is overdue. And I put this in the report this weekend. And again, you can look at this on the website. What a possibility in terms of a path of development for the next few weeks is for another pocket of balance to occur, something like this. Because what we've seen, since this low is almost dead vertical. We had dead vertical into this balance area, and now we're basically dead vertical into Friday's top. So we'll see if this was some sort of top that is signaling at a minimum some sort of balance forming for the next 2-3 weeks or so. Now let's do this. We want to clear all this. Okay, I'll just hold on. Let me see. Bear with me a minute. Okay, back to our regularly scheduled broadcast here. We have cleared that. Okay, let's take a look at a couple of technical things. And this is something I review every week. Now, I use very, very few quote unquote technical indicators. I don't use oscillators. I do use NYSE breadth. I also obviously look at VIX. I'll show you that in a minute. What you see on my screen here, if you are new, the red line at the bottom is a 10-day moving average of NYSE advancing issues. The green is a 5-day moving average of NYSE advancing issues. And the blue histogram is closing breadth. We've had divergence after divergence after divergence after divergence since the December high, and the 10 and the 5-day moving averages of NYSE advancing issues. This is not unusual, especially in a bull trend. This is actually data that is far more helpful at identifying lows than it is identifying highs. It will, you can diverge yourself of your entire account if you're trying to follow something like this. However, these divergences are persistent. And it's a heads up that, sooner or later, this market is going to have some sort of retracement that clears the air technically, or it's going to have an event a momentum event to the upside that clears the air. So that's where we are now. Another thing I'll point out, and this is in the written report that you can access on the website, again, alexandertrading.com. But breadth has been in an extraordinarily narrow range since, well, for over a month now, well over a month, well, about a month. But this, from high to low, it's just, this is really unusual. Now let's take another look, or a different look at the technical situation. Let's look at the VIX. And I do not recall a rally that has gone as long as this one has, with a series of higher lows in VIX. And this is something else that is going to resolve one way or the other. We're going to get a big spike in VIX, and we're going to get a commensurate drop in the indices, or we're going to see VIX fall off the table here and head towards new lows for the year. So that's where we are technically, guys. I hope you found value in this. Enjoy the rest of your weekend. I'll speak with you again soon.